Welcome to Capital Link's company presentation series.
Good morning, everyone. My name is Daniela Guerrero. Welcome to the 2025 Capital Link company presentation series. I'm stepping in on behalf of Mr. Nicholas Bornozis, President of Capital Link, who is away on a business trip and unable to join us today. In this series, company management highlights the company's current operations, business development, growth prospects, and sector outlook. We have with us today Mr. Carlos Balestra de Mottola, CEO of DMCOF International Shipping. DMCOF International Shipping is a leading international marine transportation company operating in the product tanker market, listed in the Milan Stock Exchange since 2007, ticker DIS.MI, and traded on the OTCQX Best Market in the US since 2023, ticker symbol DMCOF. DIS has a presence in Luxembourg, Dublin, London, Monte Carlo, Singapore, New York, and Rome. In terms of logistics, we will begin with the company presentation, followed by a Q&A session. Participants can submit their questions through the Q&A button on your screen during the webinar, which will be addressed during the Q&A session. Please note that this discussion is strictly for informational and educational purposes and should not be relied upon as investment advice or an offer to buy or sell securities. Capital Link bears no responsibility for the content. Let us now begin with our discussion. I'd like to pass the floor over to Mr. Carlos Balestra de Mottola from DMCOF International Shipping. Carlos, the floor is yours.
Thank you, Daniela. Thank you for hosting us today here. And I'll move straight into the presentation because we have quite a lot to cover. Today, we're going to be going through the presentation which we gave to investors relating to our 9-month and Q3 results, with some sections updated to reflect information which we communicated to the market since then. And then we have also a section on the market which has been fully updated to take into account the most recent developments. So moving straight into the presentation, I'll skip the executive summary as usual because it is covered in the rest of the presentation in greater detail. I'll start with this page here where we give a quick glance of our fleet, controlled fleet, which as of 30th of September was of 33 vessels, of which 26 owned. Since then, we took delivery of one vessel on which we had exercised an option at time chartered in vessels. So we now have 27 owned vessels, 3 bareboat chartered in vessels, and 3 time chartered in vessels. Young fleet with an average age of 9 years, mostly eco design, 85% of the entire controlled fleet. This year, last year, we ordered 4 LR1s, which will be delivered to us in the second half of 2027. So which will further contribute to the modernization of our fleet. In terms of financing, we have decreasing loan repayments due to the deleverage which we have pursued over the last few years. We don't have any balloons to refinance this year, and only a very small balloon to refinance in 26. This slide here we updated to take into account the contracts which we recently signed and we communicated to the market actually this morning. And so we have secured profits on these contracts for 25 of around 39 million, assuming a P&L break-even of around 15,000, full break-even including all costs. Of course, these would be our profits in 25, assuming we were to break even on the open days, which we have, which are still significant, because as we will see later in the presentation, we still have 65% of our 2025 days, which are not covered through fixed rate contracts. We also have secured potentially some profits for 26 through fixed rate contracts, and also for 27. So that provides us some security and visibility on cash flows, which we, in the very, very volatile environment in which we are in, although a very positive one, we'd like to have. On the cost fronts, we have witnessed in 24 a moderation in cost increases, as anticipated following the sharp increases experienced in 23. On the OPEX front, the increases in the first 9 months of the year were of around 3% on the daily operating costs. On the G&A front, we actually benefited from a reduction in the first 9 months of the year. We have a very strong balance sheet, a ratio of net financial position to fleet market value, which was of only 6% at the end of September, with a substantial cash equivalent position of almost $229 million. Results were outstanding in the first 9 months of the year, $163 million in profit, higher than what had been achieved in the first 9 months of 23. And of course, also in terms of daily operating results, daily TC equivalents, the results were extremely strong in the first 9 months of the year. We average $37,000, almost $600 in the first 9 months across all vessel types on the spot market. So moving on to the more strategic part of the presentation and market-related part of the presentation. Starting with our CapEx commitments. These are commitments relating to the 4 LR1s, which I referred to previously, which we ordered in 24. Most of them are concentrated in 26 and 27, the 22.3 million and the 166.8 relate to the LR1s, whilst the investments in 24 and 25 that we show here relate to TC in options which were exercised. The investment of 31 million relates to the vessel which I previously referred to, which was delivered to us in Q4, and 67 million relates to the High Leader and Navigator, which will be delivered to us between Q1 and Q3 this year. By exercising these options, we have secured young and efficient control of young and efficient tonnage. We will be able to further invest on these vessels to bring them up to our usual standards, maintenance standards, and also apply energy saving devices, which will make them more efficient. So we are happy to have added them to our fleet, and we have done so at very attractive prices at the time these options were exercised, but also if we look at vessel prices today, which are slightly lower than they were at the time of exercise, but still significantly higher than the exercise prices. Here, looking in more detail at the options which were already exercised and those which can still be exercised. These are on the bareboat chartered in vessels. There are still 2 options which can be exercised: the Fidelity and the Discovery. We haven't exercised these yet because the implicit cost of these financings is lower than what we could achieve today by financing through bank debt. although we are able to secure very competitive terms today from the banks we work with, and significantly more tighter margins that we were able to secure a few years ago, reflecting the much stronger credit rating that we have currently. The Cielo di Houston that we see on the left was the latest option exercised. We declared it this year, and the vessel will be delivered to us in September 25. We still do expect that there's a good chance we might exercise the Fidelity and Discovery this year, but it will crucially depend on the path of interest rates in the coming months and the expected path of interest rates in the future. And so we will monitor this situation dynamically before deciding what to do. On the following slide, we looked at the options on the time chartered in vessels. These were all exercised. The Pearl was delivered to us in October, and the Navigator and Leader, as I mentioned, will be delivered to us between Q1 and Q3. Here we show the difference between the market value and the exercise price at the exercise date, and also the difference between the market value and the book value as at the end of September 24. And we see that there are big deltas there. And here we look in greater detail at our TC coverage. And we see here that we have increased substantially our coverage for 25. We are now at 35%. We had announced an intention of getting close to 40% in terms of coverage for 25. We're still not there. We are working on it. We will seize opportunities as they arise. We are very positive about the outlook for the market, so we are not in a hurry to take on more coverage. But if we find the right transactions, we will do so. And going on to the following slide, here, quick glance at where the market stands today in terms of freight rates, TC rates, and asset values. And we see that both freight rates and TC rates have softened over the last few months, but they stay at historically high values. There has been quite a lot of volatility on spot rates. Currently, there is the Chinese New Year going on, celebrations going on, and therefore activity is subdued in Asia, and that is one of the reasons the market is not brilliant right now. As we will see later in the presentation, sanctions are going to be playing potentially a big role in freight rate developments this year. And but the effects of the recently announced sanctions still have to impact the market. So there was a sentiment-driven rally after they were announced, and markets moved up markedly, but since then they have corrected again. But we do expect markets to then move on and up once the effects of these sanctions start to be felt. Asset values have also softened, but especially for older tonnage, as could be anticipated, because of course older tonnage is more affected by what is going on near term than younger tonnage is. New building prices for now have stayed flat at the cycle peaks, and we have seen less of a softening for younger tonnage than we have seen for older tonnage. TC rates are still very profitable for both MRs and LR1s. what are the drivers which have led us to benefit from these very strong markets over the last few years? The main one, of course, is linked to the war in Ukraine, and how that affected Russian exports, and also EU imports. Russian exports overall were resilient. There was only a small decline relative to prior to the sanctions being imposed, but they were redirected mostly to much more distant locations. And the EU replaced those lost Russian barrels with imports also from locations which were much more distant than Russia was. So that led to an important increase in ton miles. Another important trade disruption which contributed to the very strong markets we have seen over the last few years is the Houthi attacks in the Bab el-Mandeb Strait. They led to a collapse in transits through the Suez Canal, mostly vessels linked to Russian interests and Chinese interests continue crossing the canal, and most of the other ship owners refrain from doing so. They instead sailed through Cape of Good Hope, which is meant sailing distances increased significantly. This led initially to an important increase in ton-mile demand, which, however, tapered off during the course of the year because of a cannibalization of CPP voyages by crude tankers, which meant that volumes, clean tankers volumes transported by clean tanker vessels through Cape of Good Hope declined markedly in the second half of the year. So the potential normalization of the Bab el-Mandeb Strait situation should not have a significant negative impact on our market, in our opinion, relative to what we have seen in the second half of last year. Vessels, as far as I understand, and for sure for what concerns the MICO, are not sailing mostly through the through Suez. They are still going the longer route through Cape of Good Hope. The peace truce, which currently is in place, is being monitored closely because there are several steps which must be undertaken by both parties in the implementation of the agreements. And of course, it's still very fragile and uncertain whether it will remain in place. But as I mentioned, if it were to unravel, rather, if it were to remain in place, we don't think that this will have a significant negative impact on the market. And we will look in closer detail as to why that is the case. And here we look at the cannibalization I was referring to on the previous slide. We see that over the summer, 13% of CPP trade, on long-haul CPP trade, was transported on uncoated vessels. That was a historical high share. And since then, that percentage has collapsed, reflecting the stronger markets for crude tankers in Q4 last year and in the beginning of this year. On the right hand side, we see the chart. We see the gas oil moving around the Cape of Good Hope. We see that there was a sharp increase between February and March, and then it stayed at very high levels until October, thereafter declining markedly in November and December, and also in January this year. So the large flows that we saw through Cape of Good Hope in the first between March and June were transported mostly on clean petroleum tankers. But since July, a large portion of these volumes were transported on Suezmaxes and the LCCs. And that meant that on the one hand, there was more volumes actually transported than previously, which led to a buildup in stocks in certain areas in Europe, which had to then be digested. The industrial activity in Europe was not particularly strong in the last half of the year, and therefore demand for diesel was disappointing, less than anticipated. So these stocks which were transported, however, not on product tankers, but on crude tankers, had to be digested. And that, coupled with higher refinery maintenance in the Middle East, led to a sharp drop in exports from the Middle East to Europe. And of course, also a sharp drop in volumes sailing through Cape of Good Hope. Which, however, these are the very rich ton-mile voyages, and so the fact that we didn't have these over the last few months, I believe, is one of the main reasons why the market hasn't recovered to the extent we would have expected still over the winter months. Refineries have come out of and are coming out of maintenance in the Middle East. Stocks are being digested in Europe, and US refineries are soon going to start their maintenance season. So a lot of products flowed from the US, clean products flowed from the US to Europe, replacing volumes from the Middle East. It was because of the higher costs of transporting these products over these longer routes from the Middle East. So as refineries go in maintenance in the US Gulf, I believe there's a good chance that higher volumes will be exported by the Middle East to Europe. Initially, possibly through Cape of Good Hope, but even if they were to be flowing through Suez because of a stabilization of the situation, a normalization of the situation in the Bab el-Mandeb Strait, that would still be more these volumes will be richer in ton miles than the volumes arriving from the US. So that should contribute, I expect, to a stronger market in the rest of Q1 and in Q2. So I'm quite positive we will be seeing a recovery in freight rates in the next few months. This is the other factor which I believe should contribute to very strong markets in the coming months. We have seen a sharp increase in vessels tankers sanctioned by OFAC. from 39 throughout most of last year to 200 vessels. So overall, total vessels sanctioned on a deadweight term basis represents over 7% of the tanker fleet. So that is a very significant number. And more importantly, especially the vessels sanctioned by the US authorities tend to stop trading after they are sanctioned. Out of the 39 vessels which had been sanctioned last year, 33 were not trading. So they are very effective at preventing these vessels from continued trading. Even if they do continue trading, they are likely to continue trading in a very inefficient manner, leading to ship-to-ship transfers. However, we are not still feeling the effect of this on the market because cargoes which had been loaded prior to the sanctions being announced will, in most cases, be allowed to be discharged. But we have seen already that the Shandong Port Group, which is a very important port operator in China, already announced that they are not going to be accepting sanctioned vessels. India is also most likely not going to be accepting sanctioned vessels by the US, and therefore it is very likely that in a few weeks' time, we will start feeling the effects of these sanctions on the markets. The vessel sanctions are mostly crude tankers, but indirectly, this will the tightness in the crude tanker market will also flow through to the product tanker market. Another wild card is the blacklisting of COSCO and 2 Chinese shipbuilders. We know, there is a chance that, these sanctions could become even stricter in relation to COSCO and to Chinese shipbuilding generally. Sanctions on COSCO, if they were to be imposed by OFAC, could really tighten the market significantly for crude tankers. We have seen that already in the past, and that coincided with a very important spike in freight rates. If they were to be imposed on Chinese shipbuilder sanctions, then of course that longer term could have a very positive impact on the market, because Chinese shipbuilders are dominating the tanker new building market today. Going on to the following slide. So now, after having looked at the geopolitical factors which have influenced the market over the last few years and could be influencing the market in the coming years, we move back to the fundamentals, the usual fundamentals driving the market, and oil demand and refining throughputs. Last year, oil demand did grow, although at not a very rapid pace, just less than 1 million barrels per day. An acceleration is anticipated this year, with demand rising by 1.1 million barrels per day. China, despite the energy transition push, will be an important contributor to this oil demand growth, as will India, which was last year the most important contributor to oil demand growth. Refining throughputs will also grow this year by more than they did last year, by around 700,000 barrels per day. And so also that will contribute to an increase in demand for product tankers. More importantly, as we will see later in the presentation, is where this additional volumes are coming from, and where we are going to be seeing instead reductions in volumes. Oil supply is in no way an issue. Actually, it is a positive for this year. The International Energy Agency anticipates an increase in oil supply of 1.8 million barrels per day, which is a very pronounced increase in oil supply, of which 1.5 million coming from non-OPEC countries. And in particular, the USA, Canada, Guyana, Brazil, and Argentina should be important contributors here. So the Americas region. If a large portion of these additional barrels are exported to Asia, as is usually the case, they will be very rich in ton miles, contributing once again to a very strong crude tanker market, which should indirectly benefit also the product tanker market. Here there is also a chance that the US might decide to impose tougher sanctions on Iran, as it has already done in the past. Last year, Iran was exporting around 1.6 million barrels per day of oil. When Trump was last in power, these exports were of only 300,000 barrels per day. So there's ample room for these Iranian exports to be curtailed, opening space for more exports out from OPEC, which would be transported on compliant vessel as opposed to sanctioned vessels, which are transporting the Iranian barrels. So further tightening the market for compliant vessels, but longer term also opening more space for the US shale oil producers to produce more, which seems to be one of the objectives of the Trump administration. So here too, geopolitical factors will play a big role, but the market forces seem also to be providing strong support to the market in 25. On terms of product inventories, we are below the 5-year averages, so that will not be definitely won't be one factor dampening demand as has happened in the past. If anything, the low inventories should provide a tailwind for the market. And if we look in greater detail at which products will be driving demand growth in 25, we see that it will be driven by naphtha and jet fuel, with, however, good contributions also from motor gasoline, and a positive contribution from also diesel oil expected for 25, as opposed to the contraction in diesel oil demand that we witnessed in 2024. So all in all, it's quite a positive picture in terms of oil demand. Jet fuel demand growth is slowing down because the positive impact from the exit of the COVID restrictions is diminishing or has disappeared, and we are now going back to more normal growth levels, which are, however, rather strong. So an over 2% growth in jet fuel demand is anticipated for 25. As mentioned already a few times, the fundamentals for the crude tanker segment are extremely positive. We have looked at the demand drivers mostly, which make the prospects for the sector very good for the coming years. But also on the supply side, the situation is extremely positive. The order book has grown since reaching all-time lows in 2022, but it's still at very low levels. And especially if we look at deliveries for 25 of crude tankers, they are extremely limited. Only 6 VLCCs are going to be delivered in 2025. So, and here, looking at the longer-term demand drivers for refined products and for product tankers, we see here the additions in refinery capacity, and as mentioned several times in the past, this is a continuing trend. These new refineries are being built mostly in Asia and the Middle East. And a lot of them, a lot of these additional volumes will be exported. And we are seeing a loss of competitiveness of refineries in certain parts of the Americas, in Oceania and in Europe, with important closures which have already happened and which are anticipated for 2025, in particular in Europe. So opening up space for more imports from locations which are quite distant, contributing to ton-mile demand. So there is, of course, also the increase in refinery capacity from the Dangote refinery. The increase that we show here in 24 in reality is, if we look at throughputs, is to be split between 24 and 25, but there was already a substantial ramp up in production out of this refinery in 24, but more is to come this year. The specs of this refinery are extremely high. So we expect that a lot of the product that will be coming from this refinery will be exported to markets which have more demanding specs, such as Europe, and with instead Nigeria continuing to import still products from other locations. Of course, we have already seen throughout the course of 24 a reduction in imports from Nigeria as this Dangote refinery ramped up production, but we do not expect this reduction to continue at the same rate in 25, and possibly we might see more exports out of Nigeria also, so which would be positive for the market. And looking instead at the supply picture, we see here that the fleet is aging very fast. We usually here only showed the picture for the MRs, MR1s, MR2s, and LR1s, but we have decided to include also the situation for the entire tanker fleet above 10,000 deadweight tons, because as we saw last summer, these two sectors are very closely linked, the crude and the product tanker sector. And if we look at these two sectors together, we see that the end of 24, the order book was still well below the portion of vessels which are over 20 years. And we have also a rapidly aging fleet, even if we look across all tankers in the coming years. So with a strong potential for scrapping and rising potential for scrapping from 27, both on the product tanker space and across all tankers. And in terms of deliveries, they are still at quite low levels in the first half of the year, but they do rise in the second half of the year. We have here, we show on the graph on the top In the dark blue bars, the deliveries for DMRs and LR1s, which are the sectors we operate in, and then on the yellow bars, the deliveries for all the other tankers, which in 25 consists mostly of LR2s, but of course also some crude tankers. And we see that in both cases there is this acceleration in the second half of the year. Demolitions have been minimal over the last few years, so there is ample scope for more vessels to be demolished already this year. Order book has risen. Many vessels were ordered over the last few years, but the starting point was an extremely low order book. So, and the vessels that were ordered are going to be delivered over the course of several years. So, as we see here in the slide, the fleet growth for the coming years looks manageable. If we look only at the MRs and LR1s, fleet growth this year of around 2.7% and 3.6% next year. If we look across all tankers, fleet growth of 2% this year and 2.9% next year. That is still with minimal scrapping, so which it would be consistent with strong freight markets that we anticipate for the coming 2 years. So I think that is the well, here just last slide maybe I will cover before passing over to the Q&A. We show here our NAV per share in US dollar terms. At the end of September, it was of $10.2 per share. Our shares are trading today at around 3.8 euros. Of course, this is a historical NAV, so it might have changed since then, but relative to this NAV, our shares are trading at a very steep discount in a market where we are still very profitable. So there seems to be a very attractive valuation here for investors looking at buying product tanker shares. We are not the only company trading at a big discount to NAV, but in our case, it is particularly steep. So I think that I covered the main slides in the presentation, so I pass it over to the Q&A session. I see that there are some questions here already. Well, you talked about, here's one question. You talked about LR2s trading clean. Have you seen VLCCs and other large dirty tankers trade clean after delivery? If so, has it had a major impact on the product tanker market? Yes, it did have a major impact on the product tanker market. In my opinion, I think it was covered to a certain extent in the slides that I just presented, but I can go back to the relevant slide maybe and to make the point again here. So you see here that there was this big cannibalization. The gray bars are the VLCCs which were transporting clean petroleum products. These vessels cleaned up, so they were not, most cases, they were not new buildings being delivered and transporting gas oil, as has already happened often in the past when crude markets were weak. But they were actually, in most cases, VLCCs which cleaned up to transport clean petroleum products, and the same for the Suezmaxes, which are the blue bars. Now, this is very unusual, especially for what concerns VLCCs. It is very unusual. If you look at VLCCs transporting gas oil, we always have had some some amount of gas oil transported by the LCCs even in 23 we see, but of course there was an increase in 24. But that was even prior to the summer. We had already in March and April, there was significant volumes transported also on Suezmaxes. And I mean, during those months, the market was still very strong, extremely strong, I would say, for the product tankers. So it is very expensive to clean these vessels. It's very inefficient, very time consuming, and it's also quite risky because, of course, there's a risk of cargo contamination that the cleanup is not done properly. We understand that there are some players, some oil majors and some large trading companies that were quite happy with the results of these cleanups, especially those that did it with Suezmaxes, and some of them want to continue doing so. But of course, they will do so only to the extent that there is a disparity in rates between the clean and the crude markets, which justifies such cleanups. We saw that at the end of the first half last year. We are not seeing that right now. And that is the reason why we see that these cleanups fell substantially since November last year. And given the very positive outlook for the crude tanker markets in 25, we do not expect these cleanups to be a source of big concern during the course of this year. So there might be some new buildings delivered, especially Suezmaxes. There are more Suezmaxes than the LCCs delivered this year, which might, in their maiden voyages, still transport clean products. But that is not going to be, in our opinion, as important a factor impacting the market as it was last year. And that is very positive for the outlook of the product tanker sector in the course of 25. So there's let me see if there's another question. What about tariffs on Canadian and Mexican crude? Do you think that will impact the tanker market? Yes, I think it will. It is very uncertain whether tariffs will also apply to crude exports from these countries. It would be highly inflationary for the U.S., which is dependent on the imports of crude from these countries. If the tariffs are imposed and they are significant, they are of 25%, as has been mentioned by the Trump administration, threatened by the Trump administration, then it is likely that some or a large portion of these exports are going to be replaced with imports from other countries, which are further away. So in that respect, it will be positive for the crude tanker market, and indirectly also for the product tanker market. So I think that once again, it creates an inefficiency. These tariffs, and shipping does thrive with inefficiencies. So I think that it would be positive for the market. And here we have another question. What do you plan to do on your TC coverage? Do you plan to take on more TC coverage? Well, that's a good question. We have increased already relative to when we approved our Q1 results, Q3 24 results, our coverage substantially. It was 25% at the time. Now we are at 35% for 2025. We did mention that we would like this coverage for 25 to reach at least 40%. So we will continue working to increase this coverage to those levels, to reach those levels, and possibly also go higher than that, depending on the opportunities that we will identify. We are not going to be taking coverage at any level, but if we do find the right opportunities, we will pursue them. And we will also try to increase our coverage for 26. The outlook for 25 and 26 is very positive, but of course there are lots of geopolitical variables out there which can impact the market, some in a positive, very positive way, some in a negative way. So we don't, at this point in the cycle, we are quite happy taking some additional coverage at highly profitable levels. And so there's another question here. How are TCE rates trending in the market currently? Well, now what we are seeing prior to the sentiment-driven rally after the sanctions were imposed on 161 tankers by OFAC, we have seen a softening in rates, which I believe is also driven by the Chinese New Year celebrations. As traders return to their desks next week, there might be pent-up volumes that need to be transported. I expect that the market in the Middle East and in Asia will be stronger in the coming weeks than it has been in the last in the coming weeks and months than it has been in the last few months, and possibly we will be seeing more volumes being also exported from the Middle East to Europe, replacing barrels from the US Gulf to Europe as refineries in the US Gulf enter maintenance season. So I think that will be, overall, it will be positive for the market. There's another question here. What are your future investment plans? Do you plan to grow your fleet? No, at this stage, we don't plan to grow our fleet. We have ordered 4 LR1s last year that will be delivered to us in the second half of 2027. We are going to be selling some older vessels in our fleet in the coming years. We still have 3 vessels built in 2011. They are now 14 years old. They are still earning good money for us, so we're not in a hurry to sell them. But when we do find the right opportunity, we will look seriously at the possibility of selling them. And so by the end of 27, if we do dispose of these older vessels, one of the TC-in vessels will be redelivered to its owners. We should have possibly a fleet of 33 fully owned vessels, of which 31 eco-design vessels. So a very competitive fleet. Our fleet in such a scenario would have an average age of just over 10 years. Now it's around 9 years. So it would, 3 years from now, around 3 years from now, the fleet would have aged only by 1 year as a result of us taking delivery of these new builds and selling our older vessels. We will also continue investing to make our fleet as efficient as possible. We are going to be installing energy savings devices on the vessels whose purchase options we exercised, and some of our own vessels on which we still haven't had the opportunity to install such devices. And we continue monitoring the market for new investment opportunities to increase the efficiency of our vessels, including more capital-intensive solutions, which we still haven't decided are mature enough to be adopted, but which we might decide in the future to adopt for our vessels, such as wind-assisted propulsion, if we feel that makes sense. So those are, I would say, our priorities going forward. Of course, if we were to witness a sharp correction in the market, which is not our base case, then we might be more aggressive in pursuing S&P opportunities, purchasing more vessels to grow our fleet. But we are quite happy with the position we have today, and we have a low and decreasing break-even, young, efficient fleet, with the positive market outlook, we feel we can do very well in the coming years. There's another question here. This is the last one. Are you concerned about the increase in deliveries in the coming years? Yes, undoubtedly there is an increase in deliveries, but I think it's important to put this into context. A lot of the deliveries are LR2s. These LR2s do trade often dirty, as we mentioned. As I mentioned several times, I believe the fundamentals for the crude tanker sector are very strong. So there's a high likelihood that a lot of these LR2s delivered will be trading dirty. And if we look at the fleet growth, therefore, across all tankers, which I feel is more important today than looking only at the product tanker sector, we see that the fleet growth for the coming 2 years is actually very manageable, only 2% in 25 and 2.9% in 26. So the fundamentals are strong. Then there are, of course, all the geopolitical factors we refer to, which can impact the market materially, some in a very positive way, some in a less positive way. So, but that is the nature of our market. But our base case is for a strong 2025 and strong 2026. Okay, I think that is it. I would like to thank everybody that participated in to today's presentation, everyone which submitted questions, please reach out to us if you have any other questions you would like us to answer. Yeah, and thanks again, and good afternoon to everyone.
Thank you, Carlos. Thank you all very much for joining us today at this corporate presentation, which is part of the Capital Links Company presentation series in 2025. It has been particularly an insightful discussion on D'Amico and on the sector, and I would like to thank everyone for joining us. I would like to remind you that the presentation and discussion will be available for replay up on demand on Capital Link's webinar website, capitallinkwebinars.com, and also on the Capital Link YouTube channel. Thank you to everyone for joining us today.